Good morning, and thank you for joining us today for the WT Financial Group Investor Webinar. I'm Jane Morgan, the Investor and Media Relations Manager, and today I am joined by Founder and CEO Keith Cullen. Today we'll be running through an investor presentation, which was lodged with the ASX this morning, followed by a Q&A session. So to ask a question throughout today's presentation, please use the Q&A function, which can be found at the bottom of your screen. Keith, I'll hand over to you.
Yeah, thanks, Jane, and thanks everybody for joining us. Fantastic. So today I'm going to run through a brief overview of the company and its operations, and then take you through our financial results for the year just concluded, and talk importantly about what the outlook is like for both the company and our profession more broadly. Any information provided today is of a general nature only. I'm sure most of you online have seen this one before, so we won't dwell on it, but this information is available in the online deck lodged with the ASX. WT Financial Group, well, laid out on the page here are the different entities within the group or operating divisions of the group. WT Financial Group being the listed parent company. And we operate two distinct but complementary divisions, those being our B2B division and our B2C division. So within the B2B or business to business division, we operate three different cohorts of financial advisors across the country under our Sentry, Synchron and Wealth Today brands. Now these are B2B brands. The underlying advice practices that sit underneath those brands use their own business names. That gives them the opportunity to create their own brand in their local community and to have a connection with their local community. So whilst we have acquired these businesses over the years, we have retained their brand names because it doesn't cost us a lot of money to do that, being just business to business brands. And importantly, there's a lot of legacy and brand value sitting in each of those brands, particularly for the advisors in those groups who feel a deep sense of connection with them. Many of the practices in those groups have been there for 10, 15, up to 20 years. So what is it that we do for these practices? Well, really we are the enabler of their operation. Firstly, and most importantly, we provide them their licensing, so they sit underneath our financial services license. We create all of the policy sets that they operate their businesses under and provide their advice in accordance with. We provide them support in the creation and delivery of advice to their clients, including the risk management around that, making sure that they've met all the regulatory standards that are set out for them and are operating within legislation, and that they've got strong underlying files to support the advice that they're giving. We provide them professional indemnity insurance cover under our umbrella policy. Importantly, education and professional development. And this is a key part in any professional services business, in any profession, is making sure that the professionals are keeping up with the latest industry trends and requirements. So the education and training that we provide is ongoing and a very significant part of what we do with our practices. We create the approved product list for them for the financial products that they're advising on, including maintaining the relationships with the underlying product providers. We collect all of their revenue, whether that's their advisor service fees that they're charging clients, or whether it's insurance commissions coming from the risk insurance providers. And so we provide them their revenue management solution. We support their technology in their practices, and we provide them research solutions. And importantly, also practice management support, helping them build higher revenue numbers, better profitability in their practices. And part of that is providing them with a good range of consumer education tools and client recruitment tools and client retention tools. We do all of this not through three different brands, as you see there with Sentry, Synchron and Wealth Today, but rather we do it all under the umbrella of Wealth Advisor. Now, so each of the practices, regardless of which cohort they're sitting in, they all access the same central team, the same central service operating under Wealth Advisor. And this has enabled us to drive terrific efficiency in what we're doing at a head office level, and it also enables us to provide the full broad range of services we're capable of providing right across the group of practices, regardless of which cohort they're sitting in. The final thing it's enabled us to do is now take that offering out to micro licensees. These are practices that might have gone and got their own license over the years, or even much smaller dealer groups. So we see that as an opportunity into the future. We've started to offer those services out to the broader market. Next, on to our B2C operations. So our company actually started life dealing directly with consumers under our Spring Financial Group brand, and we continue to operate that business. Look, it's down to representing less than 5% of total revenue of the group, but it does contribute about 10% of gross profit and of EBIT to the group. So it's an important part of the business, although financially it's a small part. Is what it does for us is it enables us to keep it real with our advisors. We don't need to second guess what's going on in advice practices and with advisors' clients when there's changes to tax rules, to superannuation rules, when there's market downturns or upturns, because we're living and breathing it every day. So we call it our research and development lab. It's a very important part of our business, albeit a relatively small contributor financially. People often ask, how's our revenue made up? Well, the key contributors are on the left-hand side of the screen there. We charge each of the practices in our group base fees relevant to, and it varies from cohort to cohorts, but they all normalise out to about the same level when you look at what a typical practice is turning over in revenue. So we charge base fees, and with most of the practices in our group, importantly, we collect all of their revenue and we pay a percentage of it out to them, not all of it out to them. So we're participating in the top line revenue of about 300 of the 400 practices in the group. And that's a very important distinguishing factor between us and a lot of other licensees. Then we have a range of user pay services, depending upon how active the practices are in the group, with how much advice they're issuing, and what their technology requirements are, and so on. A lot of those fees come to us on a user pays basis. To the right-hand side there, under user pays fees, a new opportunity for us is licensee and advisor services. I mentioned that we've started taking that Wealth Advisor brand and the range of services such as education and training and client recruitment and client retention tools out to the broader market. And then, of course, we have our B2C revenue, which we earn for providing advice around financial planning and accounting and mortgage broking and so on. So it's been a good year for us. We've been very pleased with the result. Our gross revenue was up nearly 60% to a bit over 162 million. Our gross profit was up 54% to a bit over 17 million. Good EBIT contribution, a little over doubling to 5.6 million, and net profit after tax more than doubling to 4.14 million. So that's strong revenue growth and strong growth in profit. That all equates to about 1.26 cents per share on an EPS basis, and a 16.2% return on equity. We think there's considerable more upside to come. So whilst we're pleased with the results, as we think that it's an early indication of what the future looks like for us. So there's a number of revenue and growth opportunities, both in the short and mid-term, to grow revenue and profit. Base fees, we see organic growth coming through new marketing initiatives of attracting new practices into the group, and also repricing some older legacy deals that were sitting within those cohorts that we acquired. Practice revenue, we're very keen to continue to work with our practices to share in their revenue and to have us aligned with what they're doing. I mentioned before, we've got around 100 practices in the group that are on fixed fees. We're very happy with the level of fees they're paying us, as we just like to change the model with some of those. So we'll be working with them over the next year or two to see if we can bring them into alignment with the rest of the group and be participating in their revenue. And that provides an opportunity and a benefit for the practices for us to share in risk with them, but also to share in the reward with them. I've mentioned that opportunity to grow the Wealth Advisor branded services. B2C revenue, I'll touch on shortly the incredible growth opportunity that we're seeing in advice generally. We've had that business of ours in somewhat of a hiatus over the last couple of years. Our focus from a management perspective and also a capital perspective has been on growing the B2B business. We think we've finished the heavy lifting there now, and so from now we'll be turning our attention back to growing that B2C revenue. And then there's an emerging market for a number of advisors wanting to focus on wholesale clients. So this is something that we're intending to roll out across the next 12 months, is a wholesale only license with a wholesale only approved product list and so on. So we see a good opportunity there to contribute to growth and profitability in coming years. So it's been easy to look negatively upon the financial advice profession over the last sort of 10 years or so, with a lot of regulatory reform and turmoil culminating in the Royal Commission that's seen a decline in advisor numbers, and perhaps investors, be concerned that it was a sector that they didn't want exposure to. In the next few slides, I'm going to explain why right now we're calling it halcyon days ahead for advisors. There's an incredible supply-demand imbalance that has emerged in this profession. Advisor numbers have dropped from a peak a few years ago of about 26,000 to, I think, around 15,500 sitting on the register today. Now, that 26,000 number was inflated by before there was a mandatory ASIC levy per advisor that started around $1,000 and next year will be $3,000 per advisor per annum. Is a lot of licensees had executive staff and non-advisory staff actually sitting on the register. So perhaps that 26,000 number was more like a genuine 20, 21, 22,000 than 26,000. But notwithstanding this, it's dropped down to about 15,500 now. That's been through a lot of the banks shutting their salaried advisor divisions, and a lot of older advisors not wanting to pass the new education standards that had come in, so they've sold their businesses and retired. With the number sitting at about 15,500 at the moment, we've got around 1,000 or 1,200 advisors naturally retiring each year, selling their businesses. So whilst the revenue might be maintained within the profession because they're selling to other practitioners, is the advisor numbers continue to drop. And then the new entrants, the barriers to entry have been set very high for new entrants. They need to do a very specific degree, and then they need to do a professional year. And this has set very high barriers to entry that not enough people are either prepared or able to cross. So we've only got about 300 or 400 new advisors coming into the profession each year. I'm pleased to say that number is growing, but it's not growing fast enough to, within the next year or two, replace that natural retirement number. So our modelling suggests that we're probably going to stabilise around 12,000 advisors in the profession. And that chokehold on new entrants will remain, we think, for some period of time. We'd like to work with government to see, some of those barriers to entry reduced, and I think this government's motivated to work with the profession on that. But we don't see that being a magic wand that's going to address that number anytime soon. So we think that 12,000 number there or thereabouts is where the profession sits for, the next 5 or 10 years. So we've had this perfect storm of supply and demand imbalance created. At the same time, advisor numbers have been falling. We've seen the number of consumers in key cohorts that are seeking advice growing. So these statistics up on this slide come from the Australian Bureau of Statistics, looking at the two census between 2016 and 21. The wealth accumulator market, which is that sort of 35 to 50-year-old market, up 8% to nearly 8.5 million people in Australia now in that wealth accumulator market. The pre-retiree market in the sort of 45 to 60-year-old bracket, these are the people that are really starting to, in many cases, panic about their retirement because they've been busy raising their family and getting on with their careers. And then they wake up one day and realise they've only got 5, 10, 15 years before they're intending to retire and they need to get themselves organised. Well, that market's up to nearly 8 million people now. Most significantly, though, this is the baby boomer market coming through. The retiree market grew by 19.1% to a total of 4.3 million people. That's people aged 65 and above in Australia. And that was as at 2021. Now, people often think about the baby boomer market as being like a snake that swallowed an egg, that it's going to be this lump of people that sort of come through and then that growth dissipates. That's what it looked like when the baby boom was happening, as the birth rate exploded for a period and then dropped back. But it's not what it's looking like as Australia's population is aging and they're moving into that 65 plus market, because what the baby boomers have been, the Australian born baby boomers have been supplemented with, of course, is massive immigration into Australia. So it's not a snake, an egg coming through a snake. It's this massive wall of people that's going to continue to grow. So whilst advisor numbers are down, the traditional cohorts that are seeking advice in that retirement, pre-retirement and wealth accumulator area, there's this wall of people coming. The capacity to pay has increased. Household incomes are up significantly in Australia, and the total number of households with $3,000 of weekly income or more jumped from 16.5% to 25%, 1 in 4 now, and it continues to grow. We've got advisor numbers down, capacity to pay up, and most importantly, the core asset pool that advisors seek advice regarding is superannuation. And we're seeing relentless growth in superannuation, and it's statutorily mandated, so it's not going away anytime soon. Wages growth is driving it, and legislation is driving it. And superannuation assets now have reached, these numbers are from December, so that 3.3 trillion is probably more like 3.5 trillion now. And that's been driven by incredible weekly inflows into super of $2.3 billion a week. Now, we do see drawdowns in super, obviously, people accessing their superannuation in retirement, lump sum payments and also pension payments. So those payments run at about $1.7 billion a week. But then on top of that, you've got net asset growth, just the market driving the growth, $1.3 billion a week. That all leads to just short of, and what has probably now gone over, because again, these numbers are from December, just short of $2 billion a week in net growth in that key asset pool that advisors are giving advice on. So we've got advisor numbers down, we've got capacity to pay up, and we've got this wall of people and a wall of capital just coming into the market. What's this mean for advisors? Well, I think as a profession, advisors in our observation continue to short sell themselves significantly. They're often put off by, we've made this transition, this whole, it was an industry a few years ago. And what's happened over the last 10 or 15 years is being a financial advisor and running an advice practice has gone from being a mass market sort of product distribution model where everybody was targeting as many consumers as they could to sign up as many superannuation funds as they could to come under their practice, because when advisors were getting investment-driven commissions, signing someone up with only 30 or 40 grand in super, well, the idea always was, well, in 10 or 15 or 20 years, it's going to be a number significantly higher than that. So I'll run around trying to sign as many up as I can. That's not what the market's like anymore. We've genuinely transitioned to a profession where the bulk of fees being earned by advisors are advice fees paid by consumers for giving them advice around their superannuation. So a fair few advisors have made this transition and made it very well. Others have made it pretty well, and some are still struggling with it. And they get turned off by surveys that they see in the market about what people are prepared to pay for advice. And one such survey was Advisor Ratings last year. They said 1 in 20 Australians was prepared to pay between $2,500 and $5,000 a year for ongoing advice. Well, that lands us about in the middle of where the average ongoing advice fee is in our experience, which is about $3,750 a year. And they said only 1 in 40 was prepared to pay $5,000 or more. Well, when we analyse the many tens of thousands, 100,000 plus clients in our advisor cohorts is we see that those clients that are paying more than $5,000 a year average $7,500 a year. And of course, there's many clients that are prepared and have the capacity and also the complexity in their finances to be paying considerably more than that. But we landed an average at about $7,500. Well, if we assume we've only got 12,000 advisors and we assume that 1 in 20 and 1 in 40, we're talking about a client pool of just over 1 million people, which equates to about 88 clients per advisor. That's a number lower than what we'd see averages at the moment. We see them at about 120 at the moment, 130. Now that's down considerably from a few years ago. That's about 40 households per advisor, or just 6% of Australian households. That's kind of a way of demonstrating that we really have transitioned from a mass market profession into a much narrower profession in terms of where the real opportunity for advisors is. That all equates out to an average of about $440,000 or more per annum per advisor. Now, I'm not talking about practice principals. We've obviously got a lot of senior advisors earning considerably more than that. I'm talking about every single man, woman, new entrant in the profession, averaging that in just ongoing advice fees. That's before we even consider risk insurance commissions and, of course, upfront advice fees for new clients, which presents an opportunity for considerable growth. So we think that all nets out to where the profession should be targeting itself, around about $650,000 to $700,000 per annum per advisor. That demonstrates that the profession currently is short selling itself by about 40 or 50%. So supply-demand imbalance, a preparedness to pay there in the marketplace, and our real focus is to work with our advisors to really capture that value out of the market and stop short selling themselves. And of course, that comes back to that important issue of us participating in the revenue upside with our practices. We help them grow, we help them become more profitable, and in doing so, as we become more profitable ourselves. I won't bore you with the details of the board, but this is in the deck. Guy Headley, Michael Harrison, Chris Colesis, and myself, a team of experienced financial services professionals with a proven track record of success individually and collectively, and strong experience in mergers and acquisitions of both private and public companies. Importantly, we are supported by a very strong senior executive team, and it's a very hands-on team with extensive experience in financial services, importantly in both B2B and B2C roles. And that enables our team to add real value to the practices that the group supports. And another important cohort amongst our many important staff and management and executives is our management team of Ben and Sarah, Bernie, Emma, Danny, and Tony. And this team is a very strong and experienced management team that supports the practices in the group across the country with a real focus on practical application to help them drive their practice growth and their profitability. And I'd really encourage you to sort of read the profiles of this team, because we've assembled a great group both through our own recruitment and through the acquisitions that we've made. And it's a people business after all. Finishing off on our top shareholders, importantly, I think for any company, but particularly in micro and small caps, this is an executive, founder and board-led company. Board and management have significant skin in the game, with us collectively owning about 32% of the shares on issue. In addition to that, we have a very strong, for a micro cap in particular, but for any business, particularly in financial services, a very strong Insto register with UIL Limited, Ariadne, IFM, Glennon Small Companies, all very experienced financial services investors who really get this space. I mean, each of those investors understands the financial advice profession, and they understand the history of it, and I think they're also seeing where the opportunity is through this supply-demand imbalance that has been the primary subject of today's discussion. So I think that brings us to a conclusion now, Jane, and happy to take any questions.
Wonderful. Thanks for the presentation, Keith. And I'd encourage webinar attendees to please use the Q&A function at the bottom of your screen to ask any questions. Keith, let me jump into it. And you did sort of mention this in your presentation now anyway, but so you say that advisors should be targeting $440,000 in revenue a year. So how does that compare to where they are now, both within your group and more broadly?
Yeah, it's interesting. Look, within our group, Jane, the number's actually lower than that number because we've got about 50 odd, I think it is, general advice practitioners who are doing insurance-only advice on a general advice basis. And so the financial advising for them is an adjunct to their mortgage broking business generally or their accounting and tax practice. So they kind of drag our averages down, but our averages are sitting a bit over 300,000. Even with that drag down. For the sort of non-general advice, it's probably pushing up closer to 400. And it depends upon which cohort of advisors you look at around, but you probably see a number of around that 440. When you say, well, what am I talking about the growth for? Well, but that 440 or 400 odd that is probably the average in the profession at the moment is inclusive of upfront fees for new advice, inclusive of implementation fees on new advice, and inclusive of risk insurance, upfront commissions and ongoing commissions. So the genuine sort of ongoing advisor service fee number is probably only around 200,000, 220,000, something like that. So we think that's where we say we're short selling ourselves by 40 or 50%, both in the ongoing fees, but also in the upfronts. I mean, there's a lot of advisors out there still now, writing statements of advice for people, and there's a lot of work involved in that, and doing it for as little as sort of, $1,500, $2,000, $2,500. The market average is there at about $3,500 for a piece of upfront advice, but it should be significantly higher than that, given the work and also given the risk associated with this profession. Like any profession, is you've got to manage risks, and a fair degree of risk passes from the client to the advisor and the licensee when it's giving advice. That risk is transferring from the client to the advisor. And we see a lot of advisors still not charging implementation fees when clients are proceeding with their advice. And so it's a big push for us to encourage advisors to do that. So we think there's big room to move for advisors in both their upfront fees, their implementation fees, but also their ongoing fees. Now, they're tougher ones to tackle because you've got to have a conversation with clients that you've been looking after for a period of time. But we see when we work with practices to work through that, the clients are understanding of it and accepting of it. The onus is on the advisors, obviously, to prove their worth. And the best way to test whether clients are valuing what you're doing is to tell them you're having a fee increase. But so we think there's great opportunity there. The other big push for us is in personal insurance risk. Is too many advisors have taken their focus away from personal insurance sales over the last few years. They're not advising their clients on it because they've decided it's too hard and too expensive. We think there's solutions available for them, and so we're very focused on getting advisors back into that as well.
Thank you, Keith. So next one, do you see financial advice just becoming for the wealthy?
Look, it's a good question, and it's definitely one of the things that the Quality of Advice Review was about that the government did, was looking at increasing access to advice. There's an interesting thing that people look at our profession and think that it's all, the more money somebody's got, the more they're prepared to pay for advice. It's not necessarily the case, and it's not necessarily, advisors don't necessarily need to target people with a lot of money. It's more people with a need and where they can have a significant impact. And the market is probably really middle Australia to middle upper Australia. And it's definitely in that retirement planning phase, transition to retirement and entering retirement phase. Good advice, not just wealth management advice around, and not just investment advice around which investments to have, but even all things being equal on the investment side, good advice can change people's outcomes in retirement by hundreds and hundreds of thousands of dollars or tens of thousands of dollars a year in income just by structuring themselves correctly. So it's not so much the wealthy, but certainly, you need a reasonable asset pool to be able to afford advice. But look, the average Australian household's got $300,000 in superannuation at the moment, and that number's only going up and up. So it's more targeting the right people that are going to get genuine value out of the advice.
Thank you, Keith. Interesting. So next one, and again, you touched on this in the presentation, but do you think overall advisor numbers will start to grow again, and why are they still dropping?
Well, they're still dropping just out of the natural retirements that I mentioned. You know, we've had this pool of 15, 20, 25,000 advisors, and, you know, most advisors, I think the average age of advisors a few years ago was sort of pushing 60. And so people retire. They've had, you know, 20, 30, 40 years of providing advice, and they want to retire. So they're selling their businesses. And so the number exiting has not so much been the problem. That's been a fairly natural number for a period of time. It's this chokehold on new entrants coming in with this new 4-year degree back and then flowing into a professional year that they need to do. So I don't see any magic wand being waved and that changing anytime soon. The government's motivated to look at it with the profession to see ways that they can, you know, change some of those barriers to entry. But I don't see that. Look, maybe my 12,000 number's wrong, and maybe over the next decade we end up averaging 14 or 15,000, but it's not going to be back to 25 or 30 or 40,000. So I think the thesis that I present today in terms of the supply-demand imbalance prevails, even if we do sort of free up the barriers to entry a bit.
Thank you, Keith. Next one. So other listed companies are investing in advice practices. Will you be doing this?
Well, look, the first thing I'd say is we're invested in our own practice. And I think I mentioned at the start is that, you know, we think the time is right to look to start to grow that contribution to revenue and profit a little bit. Look, I understand the model of practices doing that. They're trying to get closer to the consumer. One of the things that some groups face that we don't face is they've completely disconnected themselves from the upside. And that is they've put all of their practices on fixed fees. And look, if I'm a practice, I don't want my licensee on a fixed fee with me. I want them motivated to work with me and commit with me to provide the resources, the staffing at head office, and the tools to help me grow my practice so I can get on with doing what's important to me, which is sitting in the room with clients. And that's really got to be valued. Well, we're happy to do that as long as we're participating in the upside, which is what we're doing. So I think the key thing is when we look at investing in practices is we say, well, we already are invested. And the investment that we make is in having really skilled and quality personnel to support their growth. And we're motivated to help them grow, and we will profit from helping them grow because of that revenue participation that we have. Now, that all being said, there's a lot of consolidation going on within practices. I mentioned that people are retiring. So we're definitely looking at ways that we can help practices with short and mid-term capital solutions, probably from third-party capital pools, but help them coordinate it where they can buy their partners out, buy out the practice next door, and so on. So we think there's different ways to solve for that problem than direct investment and ending up with a whole bunch of sort of minority position shareholdings across a number of practices. Because anything that we do in our business, we want to be able to be replicatable across our entire network, not just cherry pick people from within the network.
Thank you, Keith. Another one. So in March 2022, the company announced the acquisition of Synchron, which was the nation's largest privately owned financial advice licensee. This webinar attendee has just asked, so can you elaborate on how it has supported WT's performance?
Oh, look, I think it's made a considerable contribution to the performances because, you know, well more than doubled our advisor numbers. And so we don't report on them individually because we don't operate them as siloed businesses. So off the top of my head, I don't know the revenue number, but probably of the gross advisor revenue in the group is we're looking at something like 60%. From an EBIT and profitability perspective, I can't give you that number because what we've done so effectively, which is enabling us to drive profitability and also to deliver what we think is industry's best suite of services to our practices, is we've brought everything together under that wealth advisor banner in the background. So look, from a management reporting perspective and everything, we consolidate everything in the group. But just off the top of my head, I'd say that the gross revenue contribution is probably something like 60%.
Thank you, Keith. Next one is, so is the trend to self-licensing a bit of a challenge, and how is WT addressing this?
Self-licensing is an interesting name. I think I've been talking to a lot of industry participants about this. We call them micro licenses because they're licenses nonetheless. They've got all the same obligations as any licensee. It's a definite trend. We're addressing it through providing services. We offer our wealth advisor services there. We think the fundamental structure of the profession remains as it is, that's beholden upon licensees to add value to the practices that operate under their licenses. And we think, the practices that we have in our group recognise that. So, but it'll be a trend. I know this, that, look, I've often said, I understand why a lot of people go down that path of charging off and getting their own license for their practice, because they've been in a dealer group that didn't support them. A lot of them felt abandoned when the banks and others ran for the door, and they didn't want to expose themselves to that risk anymore. So I completely get that. Others are doing it because they've got a particular risk profile that they want to take in the type of practice that they're going to run and the advice they're giving, and that doesn't sit well within large license structures. I can understand that as well. Those that are doing it to avoid the scrutiny of the licensing, operating under an AFSL, I think that's fraught with danger. And I think the Securities Commission will eventually bring those to heel, but I think they're probably in the minority. There is a cohort doing it thinking they can save money. And there's one thing I know for certain is it's not more affordable to run your own AFSL as a small, practice or one or two practices than what it is to be part of a decent AFSL group. You may look like you're giving less money out the door on an annualized basis, but the reality is, I gave those numbers before. Advisors should be targeting that sort of $600,000-$700,000 a year of revenue on average. The reality of that is they're not doing anything like that on average at the moment. And if I operate on a sort of professional services model of saying, and a professional should have about 46 active weeks a year, and they should be running at about 30 billable hours, productive hours a week for each of those weeks, I'd say to you that means our profession at the moment's averaging about $250 an hour. Well, that's ridiculous, right? As in gross billings, as the profession should be targeting at least $500 an hour, which gets us to that sort of $690,000-$700,000 mark that I talked about. Well, if you're targeting that, and then you're running around trying to run your own license, your own compliance regime, your own policy suite, you're needing to deal with changes in legislation, you're needing to go and access education programs for yourself, you're needing to deal with product providers yourself, your revenue management yourself, and all of that, and you're valuing your time at 500 plus an hour, which you should be. I know where the most cost-effective place to be is, and that's as part of a larger group that's going to help you grow the practice. Grow your own practice. So it's a trend. We think it's a trend that sort of stemmed out of the mass exodus of the banks, and we think that'll probably settle down a little bit now. And we think there's not just us. There's other great licensees out there that are providing great services, and we think it's where the profession sits and where the future of the profession sits.
Wonderful, Keith. Just in the interest of time, I think perhaps you want to just reiterate to shareholders what they should be looking forward to over the next 3 to 6 months.
Look, I think our real focus is at the practice level with our advisors, helping them grow so that they can take advantage of that supply-demand imbalance that's emerging. I think in the longer term from the company and for the profession generally, I think we've got a government that is motivated to work with the profession to look at ways of changing those barriers to entry so that we can get some newcomers into the profession. And they're also looking at ways of perhaps opening up new channels for practices to be able to provide advice through the hybrid use of technology and face-to-face and so on to more consumers. So I think from a regulatory perspective, this is a very heavily regulated, legislated profession that we're in. I think a lot of the turmoil is gone now. We've got a solid regulatory footing that we can all operate profitably within, but we've got a government motivated to work to find ways of getting advice to more consumers. So there's another opportunity in the midterm, the longer term.
Wonderful. Well, that's what we've got time for today. And thank you all for joining us for the WT Financial Investor webinar. If we have missed any of your questions, please feel free to reach out via the contact details, which can be found at the bottom of our ASX releases. But I want to thank you all for your time.
Thank you, everyone. Thanks, Jane.